Social media interactions become interesting only when it is two-way. You must get a fair chance to interact with the person you follow or the person whose videos you watch. I have started this new initiative, Ask Milestones to Wealth Anything, AMA in short, through which all of you can stay in touch, ask me questions you like to ask, clear your doubts on personal finance, learn more about Milestones to Wealth and about our PMS products, and stay connected. So this brings us closer. I am able to be closer to you, to help you in whatever way I can. You feel closer by asking whatever you wish to, and we grow together, helping each other along the way. So fill in this form and stay connected through Ask Milestones to Wealth Anything. Beyond just indexing, today most people think that it is enough to do indexing and forget about anything else. Just put your money every month in the index and don't bother. This is a very simple prescription which is quite popular. And in the last 5 years, this prescription has been gaining more and more popularity. Now let us look at what the Nifty has done over the last 30 years. The last 30-year return from the Nifty is an annual 12%. That's a phenomenal number. That number has actually gone up in the last 5 to 6 years. Earlier, Nifty returns were more in the region of 10%, which again is not a bad return. So every 7 years, you keep doubling your money if you get 10%. But if you take 5-year returns between 2020 and 2025, let's say you put the money in 2020 and you measured in 2025, the 5-year compounding returns of the Nifty is 15%. So we did this study as part of our iThought Nifty Vantage Point, and I'm showing it to you. And what this study told us is that the returns made between 2020 and 2025 clearly bet the historic returns of the Nifty almost over the entire period. So we calculated 30-year returns, 29-year returns, and all the way down to 1-year returns. And the 15% return over that 5-year period, 2020 to 25, has been clearly outlier. I mean, who will complain? That's where the problem starts, because the whole prescription of indexing has grown based on this 5-year phase and what happened in the Nifty over this 5-year phase. This 5-year phase is basically an outlier phase for the Nifty itself. There haven't been too many phases like this. That is what makes this whole singular prescription of indexing something that should be questioned. Here's an important point that you need to clearly understand. If you are in the formal employment system and you are contributing to the EPFO, which is the Employee Provident Fund, then you already are investing in the Nifty 50. Suppose you have in the EPFO 10 lakhs. 1 lakh of your money is already in the Nifty. I mean, it's at least 1 lakh. It could be higher also. So every year when you contribute to the EPFO, a percentage of that money goes into the Nifty by default. So you already are doing indexing to some extent in your life. The question is, should you do only indexing? You already are doing indexing, plus you have your regular monthly savings. Should the monthly savings again mirror what is happening in the EPFO, or should you try something different, like doing some active investing? Now, Here again, we are taking the Western example of indexing working very well for people. Remember, the US economy grows at around 2%. The Indian economy grows around 7%. In an economy that is growing at a higher rate, you will see a lot of economic opportunities in newer sectors. You will see greenfield opportunities. You will see sunrise industries. You will see so many things. Now, financialization is one such theme. So, multiple themes keep coming up. So, there is an opportunity to actually invest in these themes when others are yet to invest in them. I'm sure someday these themes will come into the index, like you see Zomato today. But the key thing is, if you are able to buy a theme that is going to come into the index after a while, much earlier, then you will capture most of the upside in valuation of a company till it enters the index. That's very, very important. Whether it's Sensex or Nifty, capturing the upside before a stock comes into the index is very important, because once a stock comes into an index, returns generally normalize. They don't stay outlier for a very long time. Look at all the companies that have come into the index, and you will find that once they come into the index, returns start tapering off. Look at what happened before the company comes into the index, and you'll see soaring returns. This is generally the experience. There could be exceptions, but this is generally the trend. So, how do you capture the upside in the best of companies before they enter the Nifty? You capture them by participating in active portfolios which buy them early, long before they come into the index. Now, this is what should happen for each of you. If you do only indexing, this is never going to happen. That is where the problem starts. Some people have this alternate view that, okay, I'll start with a small cap 250 index and then go to mid cap and then move to the large cap. Fair enough. There again, within an index, there will be companies that enter an index, companies that leave an index. Let's take small cap. The impact cost in companies entering an index is very high. The impact cost in companies that exit an index is also very high. So effectively, the impact cost in small indices or small cap indices is very, very high. And in a bear market, it will become higher. So it doesn't make sense to index in smaller valuation businesses, because there is a lot of cyclical risk in them. But what we are talking about is Nifty indexing, just buying the Nifty. A lot of people told me sometime back that next Nifty is better than Nifty. I told them you should avoid it. But they were doing index investing in next Nifty. I found the valuations to be very stretched. My fear was that it will come to hurt sometime. Maybe the time is yet to come, but it will definitely come to hurt. So it's very important not to invest in highly volatile indices. Indexing itself works best when you invest in a moderate to low volatility index. That's the best place to do indexing. Whereas what I find most people do or think is to invest in high risk space in indexing and hope that they'll get high returns. That's where I think there are many spoilers, and impact cost is one of them. Change in index composition is the second one, because there could be every 6 months some change in the index. Something will go out, something will come in. When you see a stock going out, you have to sell it at any price. When a new stock comes in, you have to buy it at any price. All this is going to make your indexing inefficient in smaller and mid-sized companies. Their active investing may be a better idea, provided the active investor understands the index thoroughly, identifies areas of weakness, avoids them, identifies areas of promise, invests more in those areas. All this brings in superior returns into your life. Indexing can never become superior returns over the long term. It will always hover around 12%. Now let's see what returns indexing gave over the last 3 to 4 years, because I told you that the 5-year return is 15%. What is the return 1 year 2 year, 3 year, 4 year. Let's see that. The 1 year returns in the Nifty, the 2 year returns and the 3 year returns offer very interesting insights. The 1 year returns in 2025 is 3%. The 2 year returns is 6%. 3 year returns is 10%. I told you the 5 year returns was 15%. So clearly, there seems to be a trend and a pattern emerging which I will leave to your inference. Here is the Nifty 50 vantage point which iThought shares regularly with all our stakeholders. You can have a look at this chart. It's uploaded regularly on our social media pages, more importantly on the LinkedIn page. So please follow us on the LinkedIn page of iThought PMS and iThought Connect, and you will always get these things there. It will be a good reference point for you to understand. So broadly, we have seen index returns taper off in the medium term and then again gather momentum in the long term. Now, if you are an investor who loses interest in index investing when the returns go down, then you are never going to capture the entire returns by investing more in the bottom of the cycle. So you are going to basically have a very mediocre experience. The point is, we have an opportunity in our economy to invest in better businesses than what is in the index, to invest in industries which are today not in the index but tomorrow will come into the index after the valuation goes up significantly. There's so much of early stage investing and small cap investing and mid cap investing you can do. If you do only Nifty indexing, you're going to miss out on a whole lot of things. It's very important to invest on the merit of individual businesses rather than take an umbrella view of investing and invest only in an index. Having that very precise conviction in active investing will always deliver superior returns if your conviction is in the right place at the right time. So carrying the right conviction is the challenge. I'm sure we all agree on that. But the answer to finding good conviction in the right place is definitely not avoiding going looking for it. Index investing is not the answer, because when you do index investing, you are going to think that conviction doesn't matter. If you believe that conviction matters, then you are going to raise your returns well beyond what the index has to offer. And that is something that every investor owes to himself. I know there is always this aspect of cost that comes into all these discussions. My simple prescription is this: if the returns are adequate and clearly justify whatever costs you spend, then you should not be making cost the single important driver of your decisions and judgments. Let the cost be as long as you get the desired outcomes. Don't worry too much about cost, because at the end of the day, if instead of 12% you're going to make 15% return, then your money is going to double in under 5 years. In 10 years, you will have 4x the money. On the contrary, if indexing returns come down to say 9 or 10%, then you take 7 to 8 years to double your money. And chances are at the end of 10 years, you would have a far more underwhelming performance in indexing than you would have achieved if you did active investing. This is something you need to weigh carefully. Don't let costs blind you to where opportunities are superior. Take a balanced view and make sure you beat inflation significantly and concertedly. Thank you for watching this video.